Dustin, good to see you. Today, we're going to talk through recent market volatility. Concerns about a cooling U.S. economy led to a market rout recently, with the Dow down as much as 1,100 points in early trading. Stocks and treasury yields did pair some declines after service sector data came back better than expected. Market volatility, of course, and corrections are part of the capital market landscape. Can you just talk through the volatility that we saw recently?
Sure. Well, first, a little perspective, Aaron. So year to date, the S&P 500 is still up
Right.
more than 10%. Even after these, volatile drawdowns we've seen in markets over the last 12 months, the S&P 500 is up more than 18%. So we hear in financial news, people throwing around the word crash. This isn't anything resembling a crash. We're probably overdue for some kind of a correction, especially in the tech sector. So, it could be a couple of reasons for volatility. One, being overdue for a correction. Two, the kind of movement we saw, the kind of volatility we're seeing, or some pullbacks. That tends to be consistent with this time of year. So there's a seasonal factor there, that this is just something we often see in August and September. And then the July jobs report came in soft, so that sparked some fears of recession, sparked some fears that the Fed might be behind the curve in cutting rates.
hmm I'm glad you brought up the tech sector, because you and I have talked about this before. It's been a strong year for the tech sector and also for the S&P. However, we've talked about concentration risk before, Dustin, how 82% of the movement in the market is due to 10 stocks. Is that what we're seeing?
Right. So if we look at like an index like the S&P 500, a lot of people don't realize this. They might see, positive growth in the index. Well, this year and last year, most of that positive growth came from just a few stocks.
Right.
And remember, that index is market capitalized weighted. So that means that the larger a company is, the larger representation that company has in your portfolio as part of that index. So, we discussed how, for example, the top 10 stocks in the S&P 500, there's more concentration in those stocks in that index than there has been any time in the last 50 years.
Mhm.
So it's a really good reason to consider having some strategies in your portfolio where you're not just holding an index, where you're actively picking some stocks, and maybe you've got those stocks equally weighted. Okay, because
Mhm.
we've seen some rotation out of the tech sector. We may see more of that. At some point, this trend is going to be corrected. So we don't want to have all of our positions concentrated in a few number of stocks. So if you got equally weighted strategies inside your portfolio, when that correction in the trend happens, you'll benefit from that.
So I'm glad you're mentioning, a well-diversified portfolio, which of course just investing in the S&P 500 is not. How has a well-diversified portfolio withstood this recent volatility?
Well, bonds are doing their job, right? So we're in an environment, again, where we've got attractive yields on bonds. So those yields have been adding to returns. If we continue to see softening and growth and see interest rates cut, we'll see bonds rally. So that's good for a diversified portfolio. I also think it's really important to include some risk managed strategies in your portfolio. So that's why we include in a lot of our clients' portfolio things like hedged equity, where we're able to transfer some of our clients' investment risk to other investors or other institutions through the use of options. So similar strategies like that, risk managed strategies, so that when markets draw down, we've got basically a relief valve for that portfolio of some kind.
Just to show you, Dustin, I thought this was a little bit funny, but last Friday when the markets were taking their downturn, I was plugging into Google, should I? And the first option on my drop down was sell my stocks right now. So clearly people were feeling anxious. They had to dive into Google to get financial advice. What should we be
Yeah.
keeping in mind during these volatile moments?
Well, keep in mind, people have been waiting on the next recession for the last 3 years.
Yeah, a
And
while.
and over that time period, investors have enjoyed some incredible returns. So it sounds cliche, but you want to stay diversified, you want to stay invested, and that means having a portfolio that is consistent with your time horizon and your tolerance for risk. If you need help doing that, good idea to reach out to a professional. They can oftentimes give you some good guidance.
Right. Well, having a financial plan means you don't have to go to Google the day of looking for financial advice in the moment. But
Good
that
tip.
makes a lot of sense. Yeah, of course, when you have a plan, less likely to react emotionally. Dustin, if somebody would like your help designing that plan, how can they reach you?
Yeah, they can text me or text me a question at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.